Good afternoon, ladies and gentlemen. Welcome back to Monday Weekly Market Review. Today I have with me Mr. Gerald, who just came back from a holiday in Thailand. How are you, Gerald?
Very good, very good. Had a short break last week, so feeling very refreshed and ready to share what is coming up in the week ahead with all the viewers today.
Yes, I think front and center last week, what happened were everyone was looking at the Fed FOMC results and also the press announcement. So Fed chair actually said that we are going to expect three rate cuts this year for a total of 75 basis points. So everyone, the investors, the markets, the banks, the central bank are all aligned now that we are looking at three rate cuts towards the end of the year, even though we have some pretty hot inflation data coming in the last month. So we'll go into the details of that announcement with us today.
Yes, so I did my homework even though I was doing a short break last week, and that's what I will share with everyone today. So firstly, today's sharing is for information purposes only and should not be taken to be financial advice. If you've got more questions relating to all the volatility in the market, stocks that you are looking at, feel free to join our upcoming SIAS. We are having a special edition that's coming out on the 17th of April. Okay, so this is a free webinar for all participants. To participate, you can scan this QR code and register by the 15th of April. Okay, if you find our weekly market review helpful, do scan this QR code and leave us a review on Google. And if you'd like to consider joining SIAS as a member, it costs $12 per year or just $1 per month. Okay, so what did we see in the market last week? Effectively, you have got the US S&P 500 reaching all-time highs again, now breaching the 5,200 level to close at 5,234 on Friday. Okay, as we can see, this is largely led by the tech stocks, with the Nasdaq having gains of 2.9%. Singapore, what we see for the STI is that it still remains within the 3,000 to 3,300 range, having slight gains of about 1.4% last week, with the increased optimism in the US market. Okay, so as Sunny shared earlier, what was the key development last week is really the Fed meeting. What we see here is that the Fed has kept the interest rate unchanged, so still at the high level and close to where it was previously in 2007. But what was the more important announcement that came through was that they continue to project three rate cuts in 2024. Okay, so this is unchanged from the previous Fed forecast, but because we have seen stronger than expected inflation numbers coming through in the last few months, so investors were actually concerned that that might actually change. But there was relief because of the fact that the Fed has maintained their forecast for three rate cuts this year. Okay, so this is effectively what the investors have baked into the expectations as well. So I put out the CME Fed Watch tool last night. Okay, so you can access this yourself as well if you want to be constantly keeping track of what are the latest expectations. And what we see here is quite similar to what the Fed is projecting. So likewise, three rate cuts in 2024. With the first rate cut expected to come through in the June of this year. Okay, so now that we are already towards the end of March, I think that is what is driving a lot of optimism in the market, because what this means is that we are just maybe about 3 months away from the first rate cut after this rate hike cycle that we have seen coming through over the past 2 years. Okay. The other interesting observation that I had was if I look at the expectations on the upcoming June meeting, okay, what has actually changed is that investors are now more confident about the rate cut coming through in the June meeting. Prior to last week's Fed meeting, we were at about 50+% probability that the rate cut will come through in June. But after the Fed meeting, when I checked last night, effectively the probability is now more than 60%. Okay, so investors are gaining more and more confidence that we'll see the first rate cut coming through in a few months' time in June this year. So that is really driving the optimism in the market, and we have seen that being partly reflected in the Singapore market as well. If I were to look at the top gainers in the STI last week, we see Yangtze Shipbuilding with gains of 9.4%. We see a number of REITs, Frasers Logistics and Commercial Trust, CapitaLand Ascendas REIT also having a bit of a bounce as investors gain confidence that we will see the first rate cut coming through, and the fact that we will potentially have the concerns of the higher borrowing costs being eased for some of these REITs. Okay, we also see DBS being one of the top gainers. I think is a stock that we have talked about in a few of the recent weekly market reviews. After the company raised their dividend as well as announced a bonus issue, which will be coming up in a few weeks' time. Okay, in terms of the worst performers, we see some of the Jardine-related names here, DFI, Hong Kong Land, Jardine Matheson. We also see Seatrium down by 11.2% after the company's announcement of the Investor Day and strategic review, which might have disappointed investors in terms of their guidance for the next 5 years. And we saw the share price coming down by 11% last week. Okay, if you would like to understand more about what Seatrium shared at the Investor Day, this was something that we discussed last week at the weekly market review. So you can go back to YouTube to be catching this replay. Okay, so what we are going to discuss this week instead will be two stocks, one of which also announced their strategic review last week, which is SingPost. Okay, so they have completed their strategic review. And that will involve 5 strategic trusts that they will execute over the next 3 years. As part of this reorganization, there'll be 3 new business units that I'll go through in more detail later. For those who are looking at the dividend, they will endeavor to pay out 30 to 50% of its underlying net profit as dividends from FY 2024 to FY 2025. Okay, so there's a new dividend policy that the company has come up with. And more importantly, the board of SingPost is of the view that the current share price does not appropriately reflect the intrinsic value of the company. Okay, so after the announcement of the strategic review, we saw the share price having a bit of a bounce from about 38 cents to 41 cents. Okay, but this is after the share price has come down by quite a fair bit over the past 3 months, from above 50 cents to below 40 cents per share. Okay, so earlier I shared that they will be reorganizing the business into 3 key business lines. So this is really around Singapore, where many of us might be very familiar with their postal services, and the company also had an increase in the postage rates that were announced last year. Okay, they are also big in Australia because of various acquisitions that were made earlier. So this is another geography that SingPost will focus on. And last but not least, in the international markets, because of the growth in the e-commerce business, they want to be able to use an asset-light model and through partnerships to be able to grow their revenues here. Okay, so earlier I mentioned that the board is of the view that the current share price does not appropriately reflect the intrinsic value of the company. So what they have done is to break down the key businesses. Earlier I shared that this is around Singapore, Australia, as well as international. So I think what the company has done is look at the market cap of the company, which is 0.86 billion as of the 18th of March. And then compare that to what they believe to be the intrinsic value of some of these entities, and think that it is actually below what these entities should actually be worth. So one example that they brought up is SingPost Center, where based on the valuation of the asset, it is already worth more than 1 billion as of 30th September 2023. Okay, so comparing that to the market cap of SingPost, then they believe that the value of the shares are actually below what the true value of SingPost is. Okay, so how do they intend to unlock this value? What they want to be doing is to explore strategic partnerships to be able to grow the company's long-term value to shareholders, and then at the same time monetize some of the non-core assets and businesses subject to shareholder and regulatory approvals. So we used the example earlier, just looking at the value of SingPost Center in itself, it's really worth more than 1 billion. So what they're looking to do is to monetize some of these non-core assets and businesses to be able to unlock value for shareholders. After unlocking the value and monetizing some of these assets, they intend to redeploy the capital and to return some of it to shareholders. So part of it will be used to reduce the debt. Some of it will be used to invest for growth and to enhance long-term returns. And part of it will be used to be returned to shareholders. Okay, so that ties in with what I shared earlier around the dividend policy to pay out 30 to 50% of their underlying profit to shareholders in the form of dividends. Okay, so this is the dividend policy that has been announced. We can compare that to what has been the dividend payout in the previous years. So this 30 to 50% is actually quite similar to what they have paid out in the last 3 fiscal years. We see that since FY 2020, 2021, the payout ratio was at 40%, then to 50%, and then in the last fiscal year, back to 40%. Okay, so we have already seen a step down in SingPost dividends because in the past, with a payout ratio of 60%, and up to 80%, they've been able to pay out a way higher dividend per share to shareholders. Okay, so that is SingPost strategic review. So we have got quite a number of companies that are actually going through strategic review, looking to see how they can unlock value for shareholders. The next one is Yangtze Shipbuilding, which was one of the top gainers like what we saw last week. So very strong gains year to date. We see that it has bounced from about 150 levels at the start of the year to actually close at 186, with a lot of the gains after they announced their full year results. Okay, so what I'll do is to do a recap of the full year results to see why are investors so positive on Yangtze Shipbuilding. Okay, so what we see here is very strong revenue growth for the company, with about 24 billion yuan of revenue in FY 2023, compared to just about 15 billion in FY 2020. Okay, apart from the increase in revenue, we also see an improvement in the gross profit margin as well as the net margin. Okay, so not only is it having higher revenue, the margin that is able to enjoy has been going up as well, and that's enabled the company to grow its profit. And I think that is what is driving some of the strong share price performance. Okay, so with the increase in profit, we have seen the return on equity going up to close to 20% as of FY 2023, from just 8% in FY 2020. With the higher return on equity, the company is paying out a higher dividend per share as well. So now at 6.5 Singapore cents per share, an increase compared to 5 cents in the previous year. Okay, so it has been able to keep the same dividend payout ratio, but because the profit is much higher, what shareholders get is a higher dividend per share. Okay, I think the other positive development for Yangtze Shipbuilding is the higher order wins that they have achieved. So close to 7 billion in 2023, which is an increase from the 4.4 billion in the previous year, and way higher compared to their initial target of 3 billion. Okay, so it has been able to grow the orders compared to the previous year as well as its initial target. Okay, if you were to look at the breakdown of the orders, it's actually a wide range of different vessels. So including oil tankers, including container ships, including bulk carriers. So that partly reflects the diversified business model of Yangtze where it has got exposure towards different vessel segments. Okay, and with the increase in order wins, what we see in the order book is that it is at a record high of 14.5 billion. So that will provide visibility on the company's revenue over the next few years as it constructs these vessels and recognize them as revenue. Okay, so how about the outlook for 2024? They are looking to get continued order wins into 2024, with the target for new orders to be at 4.5 billion this year, which is higher once again compared to their target last year. Okay, year to date, they've already achieved about $1.35 billion worth of orders. So the strong order momentum that we saw from last year has actually continued into 2024. Okay, so I think it's really a combination of these factors that has helped to drive the share price performance. Number one, you've got very strong profit. With the stronger profit, they are paying out a higher dividend. Their order wins has been strong, and the order momentum is expected to continue into 2024, based on their target for this year. Okay, so what to look out for this week? Okay, so first and foremost, we have got the Good Friday holiday to look out for. Okay, so that will mean that we have a shorter trading week this week. But even then, because it's close to the end of the month, we've got quite a number of deadlines coming up. The Singapore Savings Bond application closing date for this month will be happening today, 25th of March. We have got upcoming Singapore 6-month T-bill auction. Note that it's happening on a Wednesday rather than the usual Thursday because of the upcoming public holiday. And then on the US economic data side, we'll be looking out for the GDP data that is coming up on Thursday, the 28th of March. Okay, so with these developments, I'll hand over to Sunny, who will share with us how the technical indicators are looking like.
Okay, thanks, Gerald, for that insightful presentation, especially on the part on SingPost. I think it's an interesting business strategic review. The intrinsic value is actually lower than what the assets that they have, which is the SingPost Center building. And of course, if you're just looking at that, it's just the surface. We have not even touched on their Australian market, which is 5 times that of Singapore. So I think that prospect is actually very good looking ahead for SingPost development. So do keep a lookout for what they are going to be announcing next. And of course, their full year, half year results coming in April and May. So I will do a roundup on the indices. So I think the keyword that we will be talking about today, as what Jared mentioned earlier, all-time high, new record close, new record high. So these are the terms that I will say a few times later on. But first, let's touch on the Singapore market first. Of course, we have that gap up also due to the Fed announcement. And now we are pushing towards the 3,200 points level. This morning, on Monday morning, we are slightly down about 10 points. But nonetheless, I believe looking at the indicators, MACD and RSI, it looks like it's likely going to go higher and retest the high that we see somewhere in February at 3,250. And of course, that is also the high around the December or early January period, where you see 3,250 forming a double top formation, which would likely be a strong resistance to watch out for if you are trading into the STI index. So according to the indicators, the MACD is showing positive momentum right now. We are seeing that the MACD line crossed above the zero baselines as well as the signal line somewhere last week. And then that momentum seems to be increasing because of the diverging of the MACD line upwards away from the signal line. So I do believe that it will likely retest the upper bound of the range right now, where STI is trading in to 3,250 points. On the RSI side, the momentum reading right now is 60 points, also still 10 points away from the overbought level at 70. So that means that there is still healthy momentum in the STI index right now, hence not to go against the STI index for this week at least. So where would the support be? Definitely the 200 days moving average. That will be the long-term moving average. That will be a key support. If it pull back to this point, you will start to relook at the STI again. So earlier we talked about this trajectory line last Monday. Okay, this is likely where the baseline of the STI will be trading in. If it comes on to this support line again, as you can see, it's tested once, twice, and 3 times already. Come back to this point, I would surely take a serious consideration into getting a position into the STI index. And that could be around the level of 3130, 3150 level. So I have sort of upgraded, or I would say amended my support level for the STI after the Fed announcement to around the 3150 or the 3130 level, which is around here. Okay, so just below the 200 days moving average, we can consider getting to the STI index again. So do look out for all the key developments. We are seeing a bit of negative pressure. I think today is more of a profit taking after last week, a big gain and gap up. But once, let's say, if there's a chance that it cover this gap over here at the 200 days moving average, it's good to consider getting your skin in, getting your toes into the STI index again. Next, let me move to the Dow Jones Index. So all this while, for the first 3 months of this year, we have been talking about the US indices breaking all-time high, new record close. And the strategy on the US index side would always be to wait for a pullback towards the 20 days moving average, which is the Bollinger Band basis, the black and the green line that you see here. That is the signal to get back in. So with Fed coming out to tell us that the dot plot, the projection is still 3 rate cuts towards the end of the year, and in total 75 basis points of cut. Then this strategy, the macro environment, I would say, or the rate hike projection or trajectory has not changed, and hence the strategy that have been serving the market or investors well since the first 3 months of this year will continue. Thereby, if there's a pullback to the 20 days moving average, then that is the time of consideration to get into the Dow Jones Index. Okay, so Dow Jones Index, of course, we have really healthy gains among the 3 indices in the US, but the Dow Jones Index does not seem to follow or close very strongly on Friday. So that could be an opportunity. I think this is a purely profit taking in progress, not any sign of worry on the economy or how the top 30 companies in US are doing, because economic data in the past month has shown that the economy, the job market is still very resilient and still very strong, still very tight. So I think this recovery will likely continue. Okay, so for the Dow Jones Index, same. Wait for the pullback to the 20 days moving average, and then consider get back on the right up again towards the end of the year. Indicator wise, MACD has already shown a change in trend somewhere on Wednesday of last week, which is the Fed announcement period. And then you can see we now have a positive reading on the MACD indicator. Hence, that means that we have a positive momentum right now. Okay, so looking at the RSI now, we see that it has breached the 70-point mark somewhere on Thursday last week, and now it has come back down to the 61-point level. So it is still above the 14 days RSI moving average of 56. Hence, it's still a positive reading, which shows signs of very healthy momentum right now. So the uptrend is likely to continue in the mid and long term. So do wait for a pullback to the 20 days moving average, as you can see, has always been a good support level to get back on the Dow Jones Index. Next, let's move to the S&P 500, which got a better performance overall in the past 5 trading sessions. And of course, it did not pull back as much as the Dow Jones Index on last Friday. So same strategy here, same thesis over here. Pull back to the 20 days moving average means it's a buy, it's a good support level. MACD indicator slightly negative, but you can see it's very toppish right now. I don't see any signs of it correcting downwards or diverging downwards. That means that it's likely to maintain this elevated level for now, and hence the 20 days moving average could be a good level to get back on the S&P 500 index. So on the RSI indicator, you do need to pay a bit more attention. We are 3 points away from the 70-point overbought mark, okay, generally saying. But we do see that the RSI actually reached a high of 82 points in 19th of December when we have a big rally on the S&P 500 index. So same thing. Do not expect with this rally going on. I don't think we will reach the oversold level. Definitely, even reaching the 50-point neutral mark on the RSI would actually be a challenge. I would say, as you can see, from this year, if I'm going to draw a trend line connecting the low of the RSI, you would likely see that it is going to be above the 50-point neutral mark. So if let's say we get a pullback to the 60-point level on the RSI, it could actually be a good opportunity already to get back into the S&P 500 index. And hopefully, if this occur, then it will coincide with the 20-day moving average level at 5140 right now to get back on the S&P 500. So these are the key things that you can look out for if you're trading into the S&P 500 index. Lastly, the outperformer, the only index in the US or the index that managed to close in the green on Friday compared to Dow Jones and S&P 500, that is the tech-heavy Nasdaq Composite Index. Similarly, have reached an all-time high, have had an all-time new high, all-time close. So wait for a pullback to 20 days moving average, same strategy. Okay, well, of course, we know that Nasdaq is a more volatile index because of their tech focus and the higher leverage companies that Nasdaq focus on in the Nasdaq 100. So you do need to be able to stomach that volatility. But then again, having said that, the 20 days moving average still proved in the past few months to be a good support level for the Nasdaq Composite Index. So we also, if I'm going to zoom into the MACD indicator, we finally got a positive reading after last Friday where we get a positive close. So this could be the beginning of another uptrend ride that's going to happen. Okay. So even if you want, for myself, in my own opinion, I'm not concerned if any investors would be getting in right now, because that would mean that the MACD indicator is telling us that we are just starting to see a crossover, and that means the resumption of the uptrend. If you look at the RSI, that will give me more confidence as well. The reading at 62, healthy uptrend momentum kind of a reading. We still have some gap 8 points away from the overbought level. So that means that there's still upside to go for the Nasdaq Composite Index. Hence, Nasdaq Composite Index has always been the preferred index I trade in compared to the other two US indices. So same thing, same thesis, same rationale among the three US indices. Pull back to 20 days moving average. That's where you need to be alert and then look for opportunities to get into the Nasdaq or the US index indices market. Okay, that's all that I have for today. Gerald, anything to add for the short trading week that we have?
So I think while it is a short trading week, because it is close to the end of the month, always quite a number of different things to look out for, including the T-bill auction, including the SSP closing date. And then I guess since we are also going into the end of March and going to April, which is the start of another earnings season, that's something that investors need to keep a lookout for once again to see whether this strong momentum in the first quarter will continue into the second quarter.
Yeah, that's a good point over there. So as we know, valuation is a bit high right now. So we do need the earnings seasons, the next one that's coming in, to actually match up with the market valuation and expectation going forward. Else, we may see the market top out at this time. But I don't foresee it as of now. But we do need to pay attention to the earnings seasons. You are right over there. And I think that's all the time that we have for today. Just want to wish everyone a good Friday this week, a good public holiday. Have a good rest. In the meantime, trade safe and stay safe. And we'll see you again next week on Monday in the next weekly market review. Goodbye.